Welcome to the deep dive. This is where we take a whole stack of information, cut through the noise, and really pull out the important stuff for you. Today, we're diving deep into U.S. Bancorp, specifically their second quarter 2025 financial results. We've gone through their detailed financial report, listened to the earnings call, all to give you the clearest picture possible.
Yeah, and our mission today, it's really not just about reciting numbers. It's about unpacking the strategy behind them. The trends that shape the quarter, what it tells us about where banking might be headed. We'll look at why, say, a small dip in net interest margin isn't always bad news, and how a big bank like this, well, how it actively tries to evolve its business.
Exactly. So get ready for some, I think, pretty surprising facts and insights. It's really a shortcut to getting up to speed on one of the biggest banks in the country. It's about the story behind the figures. Okay, so with that mission set, let's maybe start with the headline numbers, just to ground ourselves. They reported net income of $1,815 million. That's up 13.2% from last year, quite a jump. And diluted earnings per share that hit $1.11, which is up from 97.90 a year ago. So strong top-line stuff.
Absolutely. But what's really fascinating here, I think, beyond just those dollar figures, is the efficiency story. Their efficiency ratio, it improved down to 59.2%. And this is key. They hit 250 basis points. That's 2.5 percentage points of positive operating leverage year over year. Basically, revenue grew a lot faster than their expenses. And this is the fourth quarter in a row they've done that. It really points to, disciplined management, making every dollar count.
And that shows up in the returns, too, right? An 18.0% return on tangible common equity and a 1.08% return on average assets, which are, well, pretty impressive numbers in banking. So yeah, not just isolated good figures. It feels like a broader trend of solid performance, good execution. Okay, moving on from those big numbers. One of the most interesting things I thought was this very deliberate shift in how they're making money. We're seeing a big move towards fee income. It's now around, 42% of their total revenue. Can you unpack that a bit? Why is that significant?
Yeah, absolutely. It's really significant. It's not just, finding new ways to charge fees. It's a strategic choice. They recognize that in today's environment, relying solely on interest income could be tough. So this fee growth, it was up 4.6% year over year. And the drivers were things like payment services, trust and investment management fees, treasury management fees. And the key insight, I think, is they're moving away from maybe more volatile consumer-type fees towards institutional wealth and payments. Those now make up over 3/4, over 75% of their fee revenue. It's a pretty fundamental shift in their business model focus.
And this ties directly into their digital investments, which is where it gets really interesting for you listening, thinking about your own banking. The sources mentioned several cool things like Elavon, that's their merchant services arm. It jumped 2 spots. It's now the 5th largest U.S. merchant acquirer. They're processing, get this, over $576 billion globally every year. They handle payments for 8 of the top 10 airlines, 7 of the top 10 biggest hotel brands in the U.S.
Yeah,
it's huge.
A massive footprint.
Then there's this digital trade finance thing. U.S. Bank did its first fully digital trade finance deal. They used a blockchain platform called WaveBL, and it cut the processing time from days, involving couriers and physical paper down to minutes.
Minutes.
Yeah. Plus, better security, better compliance. It makes you think, right? If they can do that for global trade,
What else?
What other slow, clunky processes are just waiting for that kind of digital fix?
Right, and it doesn't stop there.
No. They also mentioned this partnership with Firev for integrated card issuance, integrating their Elon Financial Services credit card platform. The idea is to let other banks offer these digital-first branded credit cards, but with one single interface for debit and credit, smoother experience.
Makes sense.
And finally, embedded payments, expanding solutions where payment capabilities are built right into a business's website or app. Seamless.
So you take all these digital things together. Elavon's reach, the blockchain trade finance, the integrated cards, embedded payments. It really begs the question, how do these innovations actually make things better? Not just for the bank's profits, obviously, but for businesses. Faster transactions, more security, more convenience. How does it change the game?
Good question. Okay, let's switch gears a bit. Let's talk about net interest margin. NIM, it dipped slightly this quarter, down to 2.66%. Now, on the surface, for a bank, a lower NIM might sound like maybe a bit of a concern, but the context matters here, doesn't it?
Oh, absolutely. Context is everything. It's definitely not a simple negative story. What's really interesting is that about half of that quarter-over-quarter decline, it was temporary, driven by some strategic loan sales they did, plus higher mortgage payoffs, especially back in April. The other half, That was more about competitive deposit pricing, banks paying more for deposits, and clients shifting money into higher rate accounts, which, you'd expect.
Mhm.
So definitely not an alarming drop when you break it down.
And you mentioned strategic loan sales. This wasn't just them reacting, right? It was planned. The reports say they sold off about $6 billion in loans, mortgages and auto loans.
That's right, around $6 billion. And a lot of these were kind of legacy loans, single service clients, maybe from older acquisitions. The whole point was to strategically reposition the balance sheet, make it leaner, more focused on growth areas, and especially on building deeper client relationships.
So it's like cleaning out the portfolio a bit to make room for better stuff.
Exactly. Think of it like rebalancing your investment portfolio. You sell some things to buy others that fit your strategy better. They're clearly prioritizing growth in commercial and industrial loans, C&I, and credit cards. Those two segments now make up almost half, 47% of their entire balance sheet. And importantly, those types of loans tend to come with clients who use multiple bank services.
Yeah.
So it shows that focus on deeper, stickier relationships, not just one-off transactions.
Right. And what about the other side of the balance sheet? Deposits. Average total deposits were down slightly, but again, there was a strategy there too.
Yes. They intentionally focused on, let's call them relationship-based deposits and lower-cost consumer deposits. They highlighted this product, Bank Smartly. Apparently, over half the clients signing up are new to the bank, and these Bank Smartly clients are 3 times more likely to use multiple services compared to traditional retail customers. Plus, the cost to acquire these customers is significantly lower, so it's a smarter way to grow deposits, focusing on quality and relationship depth.
Okay, that makes sense. Now, earlier you mentioned positive operating leverage, that idea that revenue is growing faster than costs. And we said it wasn't magic. It comes from really tight expense control. They've kept expenses pretty much flat for, 7 quarters now, even while they're investing? How do they manage that?
It's a great question. How do you spend money on innovation but keep overall costs flat? Their answer seems to be, harvest your past investments. Over the last 5 years or so, they poured over $5 billion into digital transformation. Serious money. And now, they're starting to see the payoff. The productivity benefits from that tech spend. So that allows them to basically self-fund new spending in tech and payments, while finding savings elsewhere, like in personnel costs, or reducing their physical branch footprint. Occupancy costs, a smart long-term play, using yesterday's investments to fuel tomorrow's growth without breaking the bank on expenses today.
So it's not about cutting back on investment. It's about being smarter with the money, optimizing, leveraging the scale they have, leveraging those digital platforms they've built to operate more efficiently.
Precisely. Working smarter, leveraging technology.
Okay, let's talk about risk. Asset quality. How did the loans perform? The net charge-off ratio, that's the rate of loans going bad, stayed stable at 0.59%. Pretty steady. And the money they set aside for potential future losses, the provision, that actually went down, both year over year and quarter over quarter.
Right. And that decrease in provision was partly due to those loan sales we talked about, selling off potentially riskier legacy loans.
But also just reflects generally improving credit quality in the remaining portfolio. Non-performing assets, so loans that are seriously delinquent, they continue to improve too, especially in commercial and commercial real estate. Now, there was a little uptick in loans that were 90 days past due but still accruing interest, but they explain that was mostly administrative stuff in commercial real estate, plus some temporary forbearance for homeowners affected by the California wildfires. So specific explainable factors. Looking ahead, they actually expect credit card losses to be low in 2025 than in 2024. And the overall net charge-off ratio, they see it staying stable or maybe even improving a bit, which is, a pretty confident outlook. That sounds reassuring. And what about their overall financial strength, capital levels, their CET1 capital ratio, that key measure of their core capital buffer that stood at 10.7%? How does that stack up?
That's strong. 10.7% is comfortably above the regulatory minimums. It gives them a solid cushion. And interestingly, they decided not to renew a maturing credit risk transfer deal. That's basically a way banks can share some loan risk with investors. Choosing not to renew it suggests they're confident in the quality of their own loan book right now. So strong capital, confidence in their assets, and they perform well in stress tests.
And having that strong capital position gives them options, right?
Exactly. Flexibility is key. They're balancing returning capital to shareholders. They have that $5 billion share buyback program authorized last year. But they're also clearly focused on using capital to grow organically, funding more loans in those priority areas like C&I and credit cards, and they're also being prudent, building up capital gradually, preparing for the possibility down the road of being designated a Cat to bank. That just means becoming subject to stricter rules because of size and systemic importance. But they don't expect that before 2027, so they have plenty of time. It's a very forward-looking, sensible approach to capital management.
Okay, so let's try and pull this all together. We've covered a lot of ground. What's the big picture takeaway for you, our listener? Our deep dive really shows a bank that's, well, it's not just drifting, it's actively steering its own ship, strategically changing where its revenue comes from, cleaning up its balance sheet with targeted sales, driving efficiency hard with tech, and doing all this while keeping credit quality solid and capital strong.
Yeah, I think the key takeaway is you're seeing a bank focused on building sustainable growth, not just chasing short-term gains. It's about diversification, the shift to fees. It's about disciplined execution, controlling costs while investing. And it's about agility, being willing to sell off assets that don't fit the future strategy and doubling down on digital, investing heavily in what they believe will define banking tomorrow.
So here's something to chew on, a final thought for you. If a huge bank like U.S. Bancorp is making these big strategic moves, selling off certain kinds of loans, pouring billions into digital platforms for payments, trade, everything, how might that actually change the banking services available to you over the next few years? What kind of new financial interactions might pop up? Maybe things we haven't even thought of yet.
Hmm.
And how could this reshape what you expect your bank to do for you?
Yeah, it's worth considering. How could these high-level strategic choices ripple down and translate into real changes benefits, or maybe even new things to watch out for in your own financial life?
Okay, that's all the time we have for this deep dive. We hope you feel much better informed about U.S. Bancorp's quarter and maybe have some new ideas to explore on your own.